that thread of currency a little bit further, obviously you mentioned dollar debasement being one of the defining stories in portfolios for investors last year, one of the key trends to watch coming into 2026. What role might currency hedging and currency hedged share classes or currency hedged ETFs play within portfolios, and how might their role evolve through this year?
So I think that a lot of clients and investors, they're quite familiar with currency hedging on the fixed income side. So interest rate parity is something that's considered, when investors are doing fixed income allocations. On the equity side, there's also a carry argument as well. So you can still incorporate carry into your position. On the equity side, it's not just a fixed income consideration. The other aspect as well is that also in terms of thinking about your risk budget as well, if you can eliminate volatility that's coming just from the FX, taking an international currency and bringing it back into the domestic currency, then that can help as well. I think all of us are anticipating that 2026 is probably a more volatile year than 2024, 2025, and we see how gold has behaved even just over the last couple of days, right? So I think it's this piece of performance as well as risk management that currency hedging is able to help with.
So you mentioned, obviously, previously currency hedging, there was most demand before in the fixed income side, evolving on the equity side as a risk management mechanism. Diving within asset class a little bit here, where have you seen the most demand for currency hedged exposure? Where are you anticipating that to evolve through this year?
Yeah, so definitely US equities. So what's been really interesting to see is that, okay, if we look at MSCI USA, for example, as a benchmark, over the last 3 years, the total return was about 74-75%. And if you didn't hedge that and you were a euro-denominated client, your return ended up being 54% in euro terms. If you were a sterling-based client, it was 56%. So you were losing about 20% just from the FX move. And then for Swiss francs, it was even worse, unfortunately. So you were having a return of basically 44%. So quite a lot to take off the table. And I'm not sure that everyone was doing that consciously. So US equities, I think, is a big part of that. It's also because of the rates environment as well. So the US has taken the lead in terms of cutting rates. And so we see, I wouldn't quite call it central bank dispersion or divergence, but maybe central bank lagging as inflation is starting to moderate globally, but not all at the same time, not simultaneously. So it's interesting, especially for us as European investors, that whether we're a sterling-based investor, a euro-based investor, a Swiss franc-based investor, that our currencies are still yielding higher than the US dollar, so that can make sense. Japan is always one where it kind of typically makes sense to hedge as well. We as a house were quite bullish on Japanese equities as well, so we actually have an overweight to them. And we think that Japan is typically a zero rates environment or close to zero rates. And so they did see a peak actually in their 10-year yield, but on the short end, typically zero rates. And so there it usually makes sense to hedge the currency too. And kind of coming back to what we were starting to talk about as well in terms of regional utilization of European ETFs, we've seen a big pickup in terms of Mexican peso hedged exposures. So especially on MSCI World and also MSCI USA. So Jamie, an interesting fact is that of all of the currency hedged exposures that are in the European ETP space, about 45% of it is hedged into euros, about 23% is hedged into sterling, and then you have another 12% which is hedged into dollars, and then you've got actually 12% also hedged into Mexican pesos. So this also underlines again the utilization of UCITS ETFs within Latin America more broadly. Very interesting.
And to your point, UCITS ETFs being more than a Europe story.
Exactly, absolutely, yeah.